$5,000 in your Airbnb dashboard. $2,100 in your bank account. Where did the rest go? The answer is simple. Most investors never learn how money actually flows through a short-term rental business. Today we're going to follow every dollar from gross revenue to real cash flow. In our last video, we looked at the strategic choice between historic properties and modern condos. But as a former banking professional, I know that you cannot deposit charm or vintage aesthetics into a bank account. Business requires cold, hard numbers. Welcome back to Smart Capital 45+. Today, we are opening the financial spreadsheet to analyze the exact mathematical model of a short-term rental business on the global stage. We will break down how each dollar generated on Airbnb is split, why amateur hosts calculate their profits incorrectly, and how to look at international property costs. Watch this video until the end, because I am going to share the exact percentage framework that institutional investors use to stress test their properties. Let's start with 100% of your gross revenue. Many people assume that if an Airbnb property generates $5,000 per month, the owner simply pockets that money. That's the first illusion. Let's remove the first layer, operating expenses, or OpEx. In the short-term rental industry, many lenders take a conservative approach when evaluating a property. They often assume that only about 75% of the property's gross revenue is available after operating expenses, effectively allocating 25% of gross income to operating costs. But it's important to understand the difference. A lender's discount is not the same thing as the property's actual expenses. It's simply a risk assessment model. In reality, there's a much longer chain of costs between gross revenue and the money that ultimately ends up in your pocket. Platform commissions, utilities, internet, cleaning, guest supplies, insurance, HOA or condominium fees, ongoing maintenance and minor repairs. After all operating expenses are accounted for, many short-term rental properties are left with only about 50% to 60% of gross revenue as operating income before taxes and debt service. As you can see, reality is much harsher than many new investors expect. Just because a lender subtracts 25% from revenue doesn't mean the remaining 75% is anywhere close to profit. And here's a perfect example: cleaning fees. Many investors assume that because guests pay a separate cleaning fee, that money simply passes through the business and doesn't affect profitability. That's a rookie mistake. New hosts often treat cleaning fees as if they sit outside the property's financial model. In practice, cleaning fees are typically included in gross revenue. That means cleaning costs must be tracked and documented just as carefully as utility bills or platform commissions. Otherwise, your actual profit may be significantly lower than expected. But there's one expense that new investors almost always underestimate: wear and tear. Every guest stay slowly consumes part of your asset. Towels wear out. Mattresses lose support. Sofas age faster. Appliances fail sooner. Wear and tear is one of the most overlooked costs in short-term rentals. This is the real profit killer. Most new investors remember to budget for electricity, water, internet, but they forget about towels, bed linens, dishes and kitchenware, mattresses, sofas, smart locks, appliances. Guests treat your property like a hotel. Everything must look fresh, clean, and modern every single day. Maintaining a property at a competitive standard requires a significant ongoing investment. Ignore that reality, and your bank account will eventually remind you. Based on my experience, many well-performing short-term rentals generate an operating income margin of roughly 50% to 60% of gross revenue after all routine operating expenses. Margins in the 40% to 50% range are also perfectly normal in many markets. Results above 60% are usually seen only with exceptionally efficient management, or in markets with relatively low operating costs. And this is only the first layer of the financial model. Because after operating expenses come taxes, capital expenditure reserves, and for many investors, mortgage payments. In the next video, we'll continue diving into short-term math. We'll cover taxes and capital expenditure reserves. Make sure to subscribe to my channel, Smart Capital 45+. See you in the next video.